Welcome to Lesson 10. This is the first in a three-part lesson about investing. Up until now, I have assumed a basic level of understanding for most students. In this lesson especially, I feel the need to start with a building block approach that may be elementary and rudimentary for some. However, I've found that many people appreciate starting from the basics. In some cases, it may even help erase an incorrect preconceived notion. This week, I will introduce two fundamental truths as well as the basic concepts of investing. I would advise everyone sit through this entire lecture, even if it starts off a little too basic. You may still learn something or have a different way of looking at something you already knew. The first big truth I want to introduce you to is that you must have money to make money. You cannot start with zero or very little and try to grow to a very large amount. This may seem basic to many of you, but I cannot tell you how many people often come to my office and assume otherwise in some shape or form. Many people often assume there's some sort of secret or some sort of way around it. Short of winning the lottery, there's no prudent way to turn $1 into $1,000,000. Anyone who tries to tell you otherwise is probably trying to sell you something, either a product, a scheme, a book, or a software. To put a finer point on this concept, you must save or acquire money before you can grow it. Building on that, there are three components to making money. In order to grow money, you need capital, a rate of return, and time. Think of these three items like your employees. If each of them are large numbers, the better results you'll yield. If one is lacking, the other one or two must pick up the slack. If two are lacking, the more pressure that puts on the third. For instance, the more time you have, the lower amount of capital and lower rate of return you may need to achieve your goal. The less time you have, the higher rate of return and the higher amount of capital you may need to have. The more capital you have, the lower rate of return and time you may need. If one was able to guarantee a higher rate of return, then they would not need as much time or capital. However, you may have the least amount of control over the rate of return component. Let's give an example. The baby boomer generation are people born from 1946 to 1964. This generation of people are now coming into retirement. Generally speaking, it's been my experience that the baby boomer generation has had some major disadvantages. To list two, the first one being the extinction of guaranteed income programs like pensions, and the subsequent replacement with defined contribution plans like 401ks and IRAs. This shifted the responsibility to contribute and grow retirement funds from the employer to the employee. The second big disadvantage I've seen them have is that there's a lack of education in how to properly use these programs and about this new responsibility. Many boomers are now knocking on the door of retirement with less than ideal capital and not a lot of time to grow it. As a result, many seek a high rate of return to overcome the two other factors. In the previous lesson, I said there's no such thing as savor's remorse. I may have overstated things. I was deriving from my experience that I've never met anyone that has said they wish they started later in life, meaning they wish they started saving later in life. And I've never met anybody that said, you know what, I started right on time. Saving earlier and more often can give people a huge advantage. This is because of the power of compound growth. I've also rarely met anyone that feels they saved just enough for retirement or any of their goals. People commonly admit that they wish they started saving earlier and or more often. Now, how do we grow money? There are three real ways to grow money, and you can do all these things each individually or simultaneously. Let me explain to you what they are. The first option is to be an owner and purchase a stake or a percentage of a business. The second option is lending your money or your asset to someone else. The third option is to purchase items with no interest other than to sell them at a higher value. As mentioned in the open courseware, we are not going to be discussing the real-life application of these individual jobs, but we'll be talking about how these aspects work as an investor. Again, this information may seem simplistic and basic for some, but I want to make sure we have the same understanding before we move to the other lessons. So let's talk about being an owner. What are stocks? Stocks, which are often referred to as equities, are essentially pieces of paper that make you a fractional owner in a company. These fractional ownership pieces of paper are called shares. This is why owners of stocks are frequently called stockholders or shareholders. The more shares someone owns, the larger percentage the company they own. I use the word fractional as it gives a better depiction of the situation. You're really only a fractional owner. For example, let's talk about Apple Computer. There are currently over 939 million shares available of the company Apple Computer. This is the same company that manufactures iPods, iPads, iPhones, and Macintosh computers. You would need to own over 9 million shares of Apple to even come close to being a 1% owner in the company. As of January 2013, being a 1% being an owner of 9 million shares of Apple would come at a sticker price of over $4 billion. If you own the common stock of a company, you have voting rights and assume all the risks and reward of being a common owner of even a regular business. If you own shares of a company and its perceived value, meaning the value of the company, increases, the value of your shares increases as well. If the perceived value goes down, the value of your shares go down as well. If the company continues to experience success, the value of your shares should increase. The open course material goes into a good amount of detail as to the transactions required to be an owner. I won't be reviewing that right now, but it's important that you review these for more detail. The open course software also discusses what an index is and how they compose and what they measure. Over time, U.S. stocks have had what's known as a positive bias. This means that for most long periods of time, the market has an upward trend. Websites like Google Finance and Yahoo Finance have great interactive charting tools that show this if you want to look up the indices listed here. I've listed the S&P 500, the Dow Jones Industrial Average, and the NASDAQ. Now, you'll notice that in any 1, 2, or even 5-year period, there's lots of movement up and down as to the value of the index. Many people get nervous about stocks because of this volatility. However, if you look at most long periods of time as segments of 10 years, you'll see that in most 10-year periods, the indices have positive nominal growth. This positive bias is even more pronounced on most 20-year rolling periods and as you stretch out those periods more and more. The important thing here that I'm trying to expose you to is that investing in a mutual fund that mirrors an index and holding it for a long period of time, either 10 or 20 years, may arguably be better than doing nothing at all or trying to time when you should get in or get out of the stock market. For those of you that don't know what a mutual fund is, stay tuned as we'll discuss that in a minute. Now, on the opposite extreme of being an owner or owning stock, we have being a lender or a loaner. Common examples of this are bonds and CDs. There are other examples as well. When you purchase a CD, you are essentially lending your money to a bank. They pay you a fixed interest rate and lend that money out to you at higher rates. They lend that money out by creating things like home mortgages, credit card transactions to consumers, student loans, auto loans, business loans, or any other loans that banks make available. So again, to recap, you lend them money, they give you interest. That's how a CD works. In turn, they take the money that you've lent to them and they make loans with it at higher rates of return in order to pay you interest back. Corporate bonds mean that you're lending money to a corporation such as IBM, GE, Verizon, and so on. Municipal bonds mean that you're lending money to a municipality such as a county within a state. And then government bonds, which are also called treasury bonds, mean you are lending money to the U.S. government. Have you ever lent money to a friend or family member before? Well, lending money like this is not much different than what we just talked about. The only differences are things like regulations, accountability, and of course, the borrower involved. The one thing that's in common, it's pretty simple. The major risk that you take when you lend somebody money is that you'll be paid back that money. What happens if a borrower sees a lot of success, strikes gold, wins the lottery, or something like that? The only benefit to you in this example or this case would be that the risk that you take lending the person that money is reduced since the borrower's ability to pay you back increases. Going back to the example of lending money to a friend or family member, let's assume someone borrowed $1,000 with the arrangement they'd pay you back $1,000 plus $100 in interest for a total of $1,100. If that person got a raise from their job or won the lottery, you can't automatically assume they're just going to give you $1,200 instead of the $1,100 they initially agreed to. As already discussed, bonds are nothing more than pieces of paper that make you a lender. I want to quickly review the only way you can lose money or make money with bonds on top of that interest. If you are the original lender and you see your loan to maturity, you may not be affected by a bond's price. If you purchase bonds from someone else or through a broker, and you're looking to sell your bonds, you are essentially taking over a loan and the price may be important to you. You may hear in the news that bond prices went up or went down. This is based upon a few things, but the two major things are credit and interest rates. Allow me to break this into simpler terms. The credit is the credit worthiness of a bond issuer, meaning the person that's borrowing that money. This is simply based upon the ability to pay back. Let's pretend you have the choice between two pieces of paper. Let's assume both are pre-existing loans that promise to pay you back $1,000 in 10 years and will pay you $600 per year from now until the 10 years is up. However, one piece of paper involves lending to a company that has declared bankruptcy a few times before and is not showing a clear level of profitability to pay you back. You're pretty unsure now how you'll be able to get that $600 per year, let alone the $1,000 in 10 years from now. The other company is very profitable and has a very stable business. If this was all the information you were working with, you would probably prefer the second choice. Therefore, someone selling both pieces of paper would need to discount the first one to sell it in comparison to the second one. As a company's credit quality increases or decreases, so does the potential price of their existing bonds. People that were the original lenders and intend to wait the entire term and get their principal back may not care what the current price is. The other factor is current interest rates. Let's assume that you've purchased a bond for $1,000 and it's currently yielding 6% or $600 per year. Look on the slide and you'll see there's a relationship between price and interest rates, kind of like a seesaw right there, or teeter-totter. Let's say a year goes by. If an investor can go out and buy similar quality bonds as the one that you own, but can now get 7%, meaning $700 for every 1,000, you would need to discount the value of your bond in order to make that $600 compete with current rates. This means you would have to sell your bond at $857 to that investor so that he can earn 7% interest. Conversely, if rates are 5% now, you could actually sell your bond for $1,200 since $600 would be 5% of $1,200. All of this is why you may have heard that if bond interest rates go up, bond prices go down. If rates go down, bond prices go up. Again, just like the seesaw you see on the slide. The important thing here to note is that bondholders that hold on to the end of the bond's term may not care. If one tries to sell a bond or buy a bond after its original issuance, there may be a premium or discount involved when transacting that bond. Next, let's talk about commodities. Commodities are merely marketable items used to produce wants or needs. Examples are items listed here on the slide: oil, natural gas, corn, gold, silver, diamonds, pork bellies, cattle, etc. But you can also include things like iron ore, coal, salt, sugar, tea, coffee beans, soybeans, aluminum, copper, rice, wheat, platinum. The list really goes on. I'd like to point you to the OpenCourseware to talk more about investing in commodities and what futures, contracts, options, all this kind of stuff looks like. Typically, there are two types of people interested in commodity investments: people with a direct interest or people who wish to speculate. People with a direct interest may include farmers or companies that rely upon a specific good and the price of that good. For example, a farmer that produces corn would be very interested in the price of corn. They may wish to reduce their risk by pre-selling their corn at a price in order to lock in a buyer as well as a price. Another example might be an airline company that wishes to pre-buy their gasoline maybe for the next 10 years at a certain price to help offset the risk that their prices could rise, the price of the gas could rise and then eat into their profitability down the road. People wishing to speculate are purely interested in making money on commodity prices as they rise and fall. They themselves would have no real use for the raw product. For instance, a speculator may be someone buying and selling corn from their office or their home, but would not want someone to drop off 1,000,000 bushels of corn in their front yard. I explain all this to point out to you that you may or may not want to invest in commodities or spend a lot of time researching these things. Many investors use commodities purely as something to diversify a portion into of their money. Many wish to stay away from it. Mutual funds offer a pretty good way to give exposure without exposing yourself to too much risk, or prepackaged programs. That way you have exposure to commodities, but you're not involved in the trading and do not run the risk that someone may deliver a bunch of pigs to the front doorstep. So let's talk about your options for investing. One can either be a direct or indirect investor. If you're a direct investor, that means you actually own and possess shares of the company, or you actually buy the individual bonds yourself. You are directly investing into the company without a middleman such as a mutual fund, ETF, or some sort of investment program. For most investors, this offers less diversification than being an indirect investor, as we'll discuss next. This is because you cannot spread your money around nearly as much. If you are an indirect investor, this means you're purchasing shares of a program like a mutual fund or ETF or some sort of pre-packaged investment. When you invest in programs like these, you are putting your money into a larger bucket of money that is able to invest in many things all at once. These things are managed for you either actively or passively. Actively usually means that there's a person or committee deciding what to invest in, when to invest, things like this on your behalf. Passively usually means there's a specific recipe or focus to the investment and is very disciplined. Passive investments usually mirror or replace an index or benchmark. Active managers try to outperform that benchmark. It's often debated which is better, active or passive management. They both have arguments and research for and against them. It's important to note that many active managers do not outperform their benchmark, especially over long periods of time. Some do, and can even do so over some do and even do so over short periods of time. Active management typically involves higher expenses, but some deliver value, some do not. Passive investing allows exposure to an investment class or index without wondering who the best active manager is in that space. It's my experience that if you're in the business of a prepackaged product, you're probably going to suggest your method is the best. This means if you're a company that offers passive mutual funds, you will probably advertise the benefits of passive investing. If you are a successfully run, actively managed mutual fund, you will certainly tout your record and history of beating a benchmark. It's my professional experience that investors can benefit from both. Certain benchmarks are very hard to beat, and trying so may be inefficient. Certain sectors of the market may benefit from an active manager who is researching companies within an industry and able to deliver value for their higher fees. However, with that said, if you are a do-it-yourself type person, you may choose just to invest in a passively managed product to get you the most exposure with potentially lower fees, and you don't have to review a professional manager's performance. On the other hand, you may be okay with a manager with a solid track record, especially if they're going to actively move from one asset class to another on your behalf. This may be okay if you like someone being in the driver's seat versus more of an autopilot kind of position. Let's wrap this lesson up by talking about leverage. Leverage is nothing more than borrowing funds at a lower rate than the anticipated rate of growth. If you could borrow at 5% and invest in something at 10%, how much money would you borrow to invest? If you knew that the investment was guaranteed, and if you knew your borrowing costs would never exceed 5%, you may borrow as much as humanly possible. In this simple example, you are actually making money with someone else's money. However, things are almost never that simple. The rate of borrowing can go up, and investments may produce lower than expected rates of return. Leverage is not for the faint of heart or for a conservative investor, since you're adding an additional risk to your portfolio. A recent example of this was the mid-2000s, when people were taking loans against their home or real estate to invest in other pieces of property or stocks. If the person was able to borrow the money, invest in something else, and then make enough money to earn a profit, even after paying the loan back, it was a success. Essentially, they would have had to close all the transactions, the sale of the other property, and then the loan that they owe with a profit. That would be successful. However, many investors lost money in the investment and then were unable to pay back their initial loan. Essentially, a double whammy. If you're going to utilize leverage, make sure you understand all the moving pieces on both ends of the transaction.